Welcome back to Global Mantra. I'm still in conversation with Nick Timberlake of HSBC Global Asset Management. Nick, let's talk about India. You've said that you're clearly building up positions there over the last couple of weeks in this fall. Where exactly are you buying?
We can't talk about individual securities, but we can certainly give you some feel for where we see some value appearing in the markets. Certainly in the financial services space, obviously a number of these companies have seen their share prices hit hard, both due to scandals, but also to a degree due to people worrying about high inflation and rising interest rates. And we think the market has discounted a lot of the negative news now into those prices. So we've been very underweight financial names. We've been adding to those names and closing that underweight position. In the industrial space, it's difficult to generalize within the industrial space, but we see good value in a number of materials names, steel companies. Also in the oil sector, we see good value there. Again, it's difficult to talk about, well, I'm not allowed to talk about individual names, unfortunately, but there are only a few energy names in the Indian market, and most of those names we find attractive.
What about big issues in India? You know, that's something that has also caught a lot of attention globally from big institutions such as yourself. You know, state-run issues. As a fund manager, are you looking forward to those issues in India?
Yes. The companies in India have raised a lot of money over the last few years, and that process is going to continue. And to a degree, that's healthy in that it produces a broader, more liquid market over the long term. As companies issue more capital, we have to consider on an individual basis, what does that mean for the returns they're going to generate? Are they going to be able to generate the same returns as they have historically, or is that capital going to be put to less good use and we're going to see returns declining? So we bear that in mind when we look at these issues. But I think for the medium term, assuming the money's being invested sensibly, this isn't necessarily a bad thing. It can create short-term indigestion in the market. If issues exceed the demand, then that can create some problems. And to a degree, you can link that also in with the outflows that we've seen from the Indian market. Foreign investors have been net selling the Indian market for a while now, and I think that's one of the reasons why it's come back so much. Not the only reason, but certainly one of the reasons.
Sectors that you would completely avoid in India, is there something that you would be completely wary of touching?
I think there's nothing that I'd highlight actually to you in terms of the big sectors. I think you mentioned at the beginning, you know, comparing and contrasting India with China. I think the Chinese picture has also been a less attractive one until quite recently. We are starting to see some value appearing in China. So in the financial services space, again, we see opportunity opening up in China. I think if you look at the headlines in the press, you'd probably be quite concerned about investing in Chinese banks. People talking about rises in reserve ratio requirements, rises in interest rates, rises in non-performing loans, more capital increases. Many of these same points that you've just raised on the Indian market also apply in China. Again, our view is that much of this is discounted now by the market. You can buy banks in China on 1.3, 1.4 times book value. Some of these banks are generating returns in the high teens or even low 20s. That's a very attractive risk reward from our point of view.
What about liquidity in the Indian market? What about fund flows as far as India and China is concerned? Because last year was an exceptional year for India, especially the last part. We got about 30% of overall EM flows. You know, this year around, the first quarter particularly has not been kind. But as funds believe that valuations at this juncture look attractive for India, you think the second half of this year could see a reversal of flows, and a strong one at that?
I think it's certainly possible. I mean, it's difficult to predict exactly how flows will pan from one point in time to another. But there were unprecedentedly large inflows into a number of these markets during 2010. 2010 was the biggest year ever for inflows into the asset class. And it's inevitable when that happens that some of that money will not be particularly sticky, will be quite short-term in nature, and will look to take profits. And we've seen a lot of that going or having already gone. You know, in terms of when the outflows stop, very difficult to predict in the short term. But I think we must be more than halfway through that process now.
Two more sectors which are, you know, gathering momentum in India. One is the energy space. There's a lot of M&A activity happening there. The second is, of course, the IT pack, which has really been a key beneficiary of the up move that we've seen in the big rally that we saw from 2003 onwards. And it's, of course, dependent on the export market in the US. both these sectors in your view? I mean, would you be looking at an opportunity there?
I think in the energy sector, obviously, a number of the companies in the energy sector do benefit from the rising oil price. I think there are a number of things taking place in terms of new developments in the energy sector, and again, without talking about individual companies, it's difficult to get into too much more detail than that. In IT services, we have some exposure, but that's really a sector that today we are still quite underweight. It's difficult to find value with those companies. Yes, they're growing quite fast. Yes, a number of them exhibit decent returns, but if you look at the valuations they're trading on as a whole, they're still on the high side. So on that basis, we found better value elsewhere in the Indian market today.
What about infrastructure, which has really been touted as a big theme in India?
Yes, and again, there's a range of different companies ranging from quite expensive to quite cheap. So yes, we've been adding to some infrastructure names, but the big, more high-profile companies, I would say today, are still on the expensive side. So we've been quite careful about which companies we add to.
When you're allocating money in India, you know, a lot of fund managers believe that it's you can find a lot of opportunities in small cap to mid cap space. As you also pointed out, some of the marquee names are a bit expensive at these levels. Is that the strategy that you would follow as well to scale up in India?
Yeah, I mean, obviously we're managing a lot of money in the Indian market. We're, I think, as foreigners go, pretty much the largest investor in the world in the Indian market as a group. And that will limit to a degree how far down the size scale that we can go. But yes, as you go down the size scale, typically what you find is that companies are less well known, less well covered by the market, and often valuation anomalies are larger. So where we can, we'll take advantage of that. And certainly I would say in the second tier of names after, if you like, the mega caps, the biggest companies, there is good value at the moment, probably more so than in some of the larger companies in India. Are
you worried about the inflation situation and how that may impact profitability for companies there?
Definitely. I mean, Indian inflation obviously was much higher than in many other countries last year, over 10%. Actually, I think this year, as things stand today, the consensus view is that inflation will finish 2011 lower than 2010. But with this high oil price in recent times, that I think is maybe going to delay the story of reduced inflation to some degree. It's a key risk that we're worrying about, not just in India, but in many other economies that are susceptible to rising soft and hard commodity prices.
All right, Nick, we'll take a break on that now. When we come back, we speak a little bit more about the overall view in emerging markets and how that stacks up versus developed markets for 2011.
When we look back, I think in 2 or 3 years' time, I'd be very surprised if we find that the developed world has somehow or other performed better in stock market terms than the emerging world. We think 2011 will be more volatile than 2010, but we're still expecting positive returns from markets overall this year.